Good morning, everyone. Welcome to our Phillip Research Morning Call. Today, we have a couple of stock counter updates. We have Ascott Residence Trust, Lendlease Global Commercial REIT, Singapore Press Holdings, UOB, OCBC, as well as Starhub. Then after, we'll end off with Singapore Weekly. So without further ado, let me pass my time on to Natalie for Ascott Residence Trust.
Thank you, Jacqueline, and good morning, everyone. So we're starting off with Ascott Residence Trust first quarter 2021 update. So this is an operational update, and there were no financials that were released this quarter. So overall, the picture is a gradual recovery. RevPAR recovered by 10% quarter on quarter. However, the improvement in operating metrics was sort of dampened by the reintroduction and extension of lockdowns in some countries. So the portfolio occupancy increased by the portfolio occupancy increased from 45% in 4Q20 to 50% in the first quarter of 2021. And this was supported by block bookings in Australia, Singapore, and the UK. So RevPAR in these three markets grew by 46%, 14%, and 16% quarter on quarter. However, RevPAR in China, Japan, UK, and Vietnam, they actually fell because of the lockdowns. Okay. Stable income properties contributed over 3/4 of 1Q20 gross profit. So this 1Q20 gross profit was, the stable income properties, which comprises master leases, management contracts with minimum guaranteed income, and longer stay properties such as the rental housing and student accommodation. These are deemed stable income properties, and so therefore it sort of mitigated the weakness in other more tourist dependent kind of geographies. Additionally, portfolio reconstitution remains on track. So during the quarter, Ascott divested Somerset Xuhui Shanghai at a 171% premium to book. So this actually unlocked or realized 135.4 million in net gains. And also they reinvested some of the proceeds, acquiring a long stay asset, which is the rental housing property in Sapporo, Japan, for 25.5 million. So of course, there will be some earnings impact because the divestment of Somerset Xuhui is a larger asset than the acquisition of the rental housing property in Sapporo. So moving on to the negatives, the arrears from Park Hotel Clarke Quay sort of increased. So during the quarter, Ascott actually issued a letter of demand to recover 5.4 million in accrued rents. This is in addition to another 3.5 million in rents under the statutory repayment scheme that remains outstanding. So for this asset, Park Hotel Clarke Quay, it was acquired as part of the Ascenders Hospitality portfolio. And during the months of April to December in 2020, this asset was block booked by the government. Yeah. Okay, and currently from May to June, it has been rebooked by the government. So for the most part of last year, the asset remained cash flow generating. And in the management's opinion, there's no reason why the lessee cannot pay for their arrears. Yeah. So in any case, there is 6.8 million in security deposits that has been taken from this tenant. It is equivalent to 6 months of rent. So the Ascott remains optimistic that they will be able to resolve and renegotiate this issue. Additionally, 10% of rebates were given to struggling tenants. And of course, as the situation progresses, Ascott will decide whether or not more help is needed or to gradually ease off the help. Moving on to outlook. So Ascott is actually facing shorter income visibility due to shorter forward bookings. So of course, while there has been some recovery in corporate booking and domestic leisure demand has picked up, as the pandemic remains in a state of flux, and there might be snap lockdowns announced whenever. So leisure guests are actually booking less than 1 month in advance. In terms of acquisitions, it will likely be in the extended stay asset class. So that means to say it will be your rental housing or your student accommodation assets. And currently this segment represents about 7% of the assets under management, AUM, and Ascott intends to grow this asset class by to 10 to 15%. So overall, our investment action is downgrade to accumulate, unchanged target price of $1.17. So we lower our FY21 and 22 DPUs slightly by 0.9% and 3.6% to reflect the divestment of Somerset Shihui, as well as the partial offset of the acquisition of Sapporo rental housing asset. So in the year 2021, we actually assumed a 20 million capital distribution that will help to sort of support the DPUs, especially in light of this divestment of Somerset Shihui. Yeah. So overall, the recovery timeline may be a bit more protracted in the face of virus mutation and the new waves of the virus. Okay, so that's all for me. I'll now pass on the time to Jie-Hui. Sorry, there's one more slide. Okay, so this slide actually summarizes the divestments that have been announced over the last 5 years. As you can see, the second last column, that is the selling price above book. So at what kind of premiums were these assets sold off at? So the most recent asset sold off at 171% price above book. That was the Somerset Shihui asset. So it actually unlocked a significant amount of gains for Ascott, $110 million. Of course, there are some other notable divestments sold above 60%, 52%, 69%. These are the assets that were divested in 2020. And this divestment above book was despite it being a COVID year. So Ascott's properties still remained well located and well desired. And also part of the reason why these assets were able to command such a high selling price was because the buyer was willing to pay additional amount of money to convert this asset into a residential kind of asset, so a redevelopment premium, etc. Yep. Another notable divestment was Ascott Raffles Place, which was done in 2019. So this asset still remains a service resident asset. Yep. And it was sold at about 64% above book. Yeah. Okay, so I think the long story short here is that within Ascott's portfolio, there might be some assets that still have this opportunistic divestment potential. Of course, we're not. This is not really Ascott's core business, or to divest and flip assets, but it is still one way in which we see that Ascott has been able to unlock value. Yeah. And overall, over the last 5 years, the net gains above book value is about 49.2%, and over the last 5 years, the net gains that were realized from the sales amounted to almost $414 million. So that's all for me. I'll now pass the time on to Jie-Hui.
Okay, thanks, Nat. Next, we have our 3Q update for Lendlease. It's a business update where they went through their key operational highlights. So there were no financials provided. Yeah. Starting with the positives, 3Q21 tenant sales and visitation recovered 94% and 77% to that of 3Q20's levels. So if you could recall, January to March last year was right before COVID-19 impact fully kicked in. Tenant sales then were close to pre-COVID levels. So it's evident that tenant sales has recovered well since it's only 6% down on a year-on-year basis. Footfall recovery is slower in comparison as border closures are still in place. International travelers make up 20% of 313's footfall historically. For the next positive, we are also not expecting any significant impact from the Code of Conduct. So just some background, the Code of Conduct was introduced on 26th of March. It provides guidelines for the negotiation of these agreements in 11 areas, which includes rental structure and third-party fees. So long story short, LV believes that their portfolio will be minimally impacted given that their current practice is largely in line with the code. Any effect will take in the form of slightly lower rental and utility income from some leases that are contracted after 1st June 2021. So in general, overall impact for LREIT's net property income is expected to be less than 1%. An update for the Grange Car Park redevelopment. The new event space has been substantially leased to Live Nation, which is one of the world's leading live entertainment companies, as anchor tenant. Their past concerts had world-renowned artists and bands like Blackpink, BTS, and Mayday. So looking at possible 2 to 3 shows per day and 3 to 4K traffic per show, it's likely that we'll see a huge jump in traffic when the development is finally operational. The development is expected to commence in second half of 2021 and to be completed in 2022. As for the negative, we are expecting higher redevelopment costs for the redevelopment projects that are underway right now. So due to costlier labor, additional PPE and safe distancing measures at work sites, the cost of redeveloping the Grange Road car park is expected to increase. In addition, considering the potential increase, in addition, LREIT also actually had this plan to improve the plot ratio at 3:3. In light of the higher development cost, LREIT has decided to unlock the additional GFA in stages. This is to ensure minimal disruptions to the footfall and sales for the mall. We are expecting AI contributions to valuations to be delayed till FY22. Now, in terms of outlook, as Singapore raises its defense against COVID-19, the occupancy limit for malls has been reduced again to 1% per 10 square meters of GFA from 8 square meters. This ruling will apply till 14th May. Also, starting 8 May, smaller social gatherings are also mandated and is likely to be in place till the end of the month. We're expecting footfall in 4Q21 to be compromised, although sales may hold up with more marketing campaigns such as food delivery to help tenants tide through the spirit. We are not expecting any rental rebates to be given though. On the side note, Sky Complex in Milan is still going strong. It's expected to continue anchoring the portfolio with its stable recurring income. So in conclusion, we are maintaining the accumulated call with an unchanged DDM target price of 82 cents. The current price translates to FY21 distribution yield of 6% and total upside of 10.8%. Yeah, so this is all for Lendlease. I'll pass my time on to Timothy for SPH.
Yep, thanks, Jie-Hui. Okay, I'll be covering the SPH restructuring of its media business. So this is how the restructuring deal will go. SPH will be transferring the media business into a non-profit company, also which is structured as a company limited by guarantee. And the reason why this structure, company limited CLG, is that so that the SPH media business will be able to get funding from the government because it's a non-profit organization. So a total of 351.3 million will be transferred over to this not-for-profit company. So the assets that will be transferred over is about 89 million worth of media companies and about 150 million worth of market value of leases in the two buildings, SPH News Center and SPH Print Center. Then SPH will also fund the media company so that you'll be able to operate for 3 to 4 years, after which the media company can seek its own sources of funding, either from the government or from other sources. So total capitalization that SPH will provide the media company is in SPH shares, so about 22 million in SPH REIT shares, about 14 million worth of SPH shares, and 80 million of cash from SPH balance sheet. Also, the debt from the SPH media business will remain in SPH, so the debt will not be transferred over. With regards to the matrix after this restructuring, SPH matrix will remain little change. If you look at the table at the bottom right-hand side, so the change, this is the current, we have the current, and then we have the after, and then we have the change. So overall, net assets for SPH will decline by about 6.7%. The net debt to assets will increase slightly to 1.5% because of the reduced assets that SPH has. But the interest cover the interest coverage will improve because the media business was loss-making. So if we remove the loss-making portion of the business, the interest cover improves slightly from 2.1 times to 2.2 times. But overall, it's still relatively stable, and slight improvement in the profitability of SPH. With regards to the valuations, after the restructuring, SPH valuations still look undemanding, especially after the 15% drop last Friday. So if we strip off the media business, the loss-making media business, the PE ratio for FY21 estimate is about 9.4%. The PE ratio is slightly lower. That's because we removed the loss-making business, so it's a bit slightly cheaper without the media business. So if you look at the chart on the bottom left-hand side, you can see that the PE ratio after stripping out the media business is still below levels when SPH still had the media business inside. So we should, by right, we should expect a higher PE ratio because we're removing a loss-making business. And so maybe we might be able to expect PE ratios to normalize closer to the 3-year average of around 12 times, simply because of the removal of the loss-making business. On the book value side of things, it's still historically low at 0.68 times. And if you look at if you look at SPH 66% stake in SPH REIT, that is worth about 2.82 billion, and which is already more than SPH market cap as at last Friday, 2.43 billion. So from a book value perspective, it's still on the low end. It's still on the low side of things. So valuations still look undemanding, especially after removal of the loss-making business. So the timeline will be, they will have an EGM shareholder approval from July to August this year, and they aim to complete the whole restructuring process of removing the media business by 4th quarter 21 or early 2022. With that, I'll pass my time on to Terence.
Thanks, Timothy, and good morning, everyone. In our next slide, we summarize UOB's first quarter 21 results. Earnings of $1 billion came in at 25.5% of our full year 21 earnings forecast, boosted by stronger than expected non-interest income. You can see on this table on your left-hand side, under the other non-interest income row, other non-interest income actually rose on higher net trading income, which rose on 62% on a quarter-on-quarter basis. So NIM was also unchanged quarter-on-quarter at 1.57%, helped by the lower cost of deposits. Guidance for full year 21 remained unchanged. For first quarter of 2021, the credit costs declined 26 basis points on a quarter-on-quarter basis to 29 basis points. The full year 21 guidance is 30 basis points now, down from the 30 to 40 basis points previously. In our next slide, we summarize the key positives and negatives from their results. Yeah, so next slide. Okay, yeah, so for the positives, net interest income grew 1% quarter-on-quarter, with NIMs coming in stable. The net interest income increase was led by loan growth of 4% in Singapore and North Asia. There was also a robust growth in fees and commissions. Fees and commission income grew 24% on a year-on-year basis and 22% on a quarter-on-quarter basis. This came from record wealth management AUM and a pickup in equity markets. One of the negatives, though, for us in this quarter is there were no write-backs despite the stabilizing outlook. So if you look at you look at the table on your left-hand side, you can look at the allowance at 201 million provision made for first quarter 21. This is the highest amongst the three banks. So the amount of allowances remain elevated despite the outlook stabilizing. Yeah. In our last slide on UOB, we sum up the outlook and our recommendation on UOB. We see the profit outlook improving for the full year 2021 on three main reasons: stabilizing margins, stronger fees, and lower provisions. We should see UOB's profits improve for the rest of 2021. UOB has also indicated that they are keen to review assets that Citi has put up for sale in the Asia Pacific. The information memorandum is expected later this month. More details will follow after UOB review the IM. So we will release more details on this once they are done with the IM. In terms of our recommendation, we maintain accumulate with an unchanged Gordon Growth model target price of $28.70. Our target price is based on 1.17 times FY21 earnings price of FY21 price to book value rather in our Gordon Growth model valuation. You can see this on the table on your right hand side. Yep, so that's all for UOB. In our next slide, we summarize OCBC's first quarter 21 results. Their earnings of $1.5 billion beat our expectations by 27% on lower than expected credit costs and higher non-interest income. Their general provisions also fell to just $9 million for a 1 basis points credit cost. So you can see that's 1 basis point credit cost is really the signals, in our view, the end of the crisis for OCBC Group. Overall, their allowances for first quarter came in at $161 million. So we see the potential for write-backs in the subsequent quarters. Because of their strong results, the CET1 also rose another 30 basis points to 15.5% from 15.2% last quarter to support the pre-COVID dividend per share of 56 cents per annum. We think that once dividends restrictions are lifted, there's further upside for the dividend. In our next slide, we sum up some of the positives and the negatives for OCBC Group. For this quarter, we saw robust growth in non-interest income. Non-interest income rose 17% on a quarter-on-quarter basis. This was driven by a 28% increase in wealth management fees as market sentiment improved. Profit from their insurance business, Great Eastern, also surged 191% on a quarter-on-quarter basis from mark-to-market gains as market conditions improve. And also on a year-on-year basis, if you look at the table on your left-hand side, you can see on a year-on-year basis, the insurance business actually surged 298% due to favorable market conditions. The provisions were also lower than we expected. Total allowances for the first quarter 2021 was $161 million, and $9 million was from the GPs. So there's some confidence of this $864 million in GP build up for any asset quality deterioration in financial year 2021 will provide sufficient buffer. So because of this sufficient buffer, there's a likelihood that they may just reverse some of this out in the subsequent quarters. The negatives for us in this quarter for OCBC is the weaker loan growth. Net interest income was actually flat on a quarter-on-quarter basis, even though loans grew 1%. And the loan growth came from Greater China and to its network customers in the UK. For our last slide on OCBC, we sum up the outlook and the recommendation for OCBC. Loan growth is expected to accelerate in the remaining 3 quarters for OCBC due to improved consumer confidence, which is expected to prop up the consumer sentiment. For full year 2021, we expect mid to high single-digit loan growth. The strong capital position of OCBC also raises the prospect of a dividend hike once the MAS restrictions are lifted. So we maintain our buy call on OCBC with a higher Gordon Growth model target price of $14.63, up from $13.65 previously. This is because we raised our full year 21 earnings by 5.6% for higher insurance and wealth management income and lower allowances for the full year of 2021. We now assume 1.27 times full year 21 price to book value in our Gordon Growth model, up from 1.19 times previously. You can see here the table on the right hand side, our ROE actually improved from 9% to 9.5%, resulting in the higher target price for OCBC. That's all from me. I'll now pass on the time to Paul.
Yeah, thanks, Terence. We'll move on to Starhub's first quarter update. The final quarter of roaming drag. So the reason for the title is just that, as you know, Starhub and of course even Singtel, they are faced with the drag of roaming revenues as the borders are closed. Next slide. So as you can see from the table on the left, most of the weakness came from mobile. You can see, sorry, it's a bit small, the 20% year-on-year drop for mobile revenue. And as highlighted many times before, I think this is because roaming revenue accounts for 20% of total revenue. and it's also one of the highest margins part of their revenue, of the various revenues for them. So this, the big drag is of course mobile. In terms of the positives, I think broadband did well. So broadband, you can see again on the table, was up about 12.7%. So what has happened for broadband, you can see from the commentary that the broadband, the ARPU, so the prices actually rose 15%, but subscribers was basically stable. So I guess there's a greater acceptance of higher prices, obviously, especially in view of the current lockdown situation. The other positive was free cash flows. They continue to generate almost 100 million of free cash flows. So this will lend support to their guidance dividend per share of at least 5 cents. So the minimum they're going to pay is 5 cents for this year. In terms of the negatives, cybersecurity was a big drop. So cybersecurity, you can see again from the table, sorry, it's a bit small again, it's about 31.9% drop. So this is a bit surprising. I know cybersecurity is supposed to be the most hyped up, it's supposed to be the fastest growing enterprise spend. So we were also a bit surprised. What the reason they given was that there was a lumpy project a year ago. And because cybersecurity, there's a lot of confidentiality behind it. So obviously they don't give us much details. But what they did say was that outlook was healthy. So we're still sticking to our 30% revenue growth for this segment. The other weakness is pay TV. So pay TV is on a structural decline. I think you can see from the revenue down, but I guess in terms of subscribers, the subscribers now stand at 310,000. So this is the lowest we ever seen since the IPO, so like a decade, more than, you can calculate, like 15-year low. Something like that. And then the problem is also the churn has accelerated. So as you know, 2 years ago, they actually changed from cable to fiber. So obviously a lot of customers left. Then from there, we thought it should kind of stabilize. But then now you can see the churn again. That means customers leaving the network. So this is going to be a problem. I think this is a structural weakness for the business. In terms of the review, the results are basically in line for us. The outlook is that we are just looking at the stable 2021. I think the worst of the roaming revenue has weakened, but until the borders reopen, there'll be like more like flattish kind of earning EBITDA growth for them. So in terms of our view, we still maintain a neutral. And our target price, we peg it to the regional peer 6 times. I guess the one interesting point, I guess, is that for Starhub is at 5 cents, they are paying around 4% dividend yield. And then, you just have to wait, I guess, for some upside optionality, if when international borders reopen. Obviously, we do not know when, but if they do open, then you get the earnings growth back, and then you get paid 4% as you wait. And of course, the main one is Malaysia. I think Malaysia accounts for almost 20 to 25% of all the roaming revenue. So it's important that Malaysia reopens for this thing to come back, for roaming revenues to come back. Next slide. So we'll just move on to our usual weekly. Next slide. There are quite a bit of macro news for Singapore for the past week. We got visitor arrivals. I think obviously it's still really bad. We used to get like 1.6 million. Now we got 25,000. So, no change in that. Hotels are also still suffering. The RevPAR can think of it like revenue, like in general, is the room rate and over occupancy. So you can just think of it like the revenue, monthly revenue, like one way to kind of look at it. So they are getting like $69 per room average, and then right now the average before pandemic was 220. So you can see the drastic decline in revenues for the hotel industry. Manufacturing is still doing well. The PMI is actually about 2.5-year low, so that is progressing well. Our retail sales is recovering. So finally, we got like a year to date, we got a positive. So year to date 2021 retail sales is up, but again it's very modest, 0.1, 0.4. Supermarket sales was very weak, but again it's a bit hard to use this month because this was comparing to the pandemic, the circuit breaker time, when everyone was like hoarding stuff. But if you compare March supermarket sales versus pre-pandemic, the March 19, it is up 17%. So it's still a very, very strong number. I think pre-COVID supermarket sales was like 1-2% a year. So although it's big year on year, but it's still really strong compared to pre-pandemic levels. The other big macro was from the US, and it was the employment, the jobs data. I think you can call it like the world's greatest economic forecast miss, because in April, the actual jobs, that means payrolls, that means the amount of new people, the amount of people getting jobs in the US was 266,000. But the most economists, the consensus was like 1 million. So obviously, their forecasting is like mine, just as good as mine, which is really poor. Then, okay, the other thing was that this compares to March, 770,000. The key thing is that since the pandemic, that means since the COVID happened, the US is still down 8.2 million jobs. So this will, obviously, like we highlighted before, this will keep the Federal Reserve from raising interest rates. The other weak number was that last month, actually, March was 916,000. Then they actually revised it down to 770,000. So in a way, you got two negative numbers. You got like, you missed the estimate in April, then in March, you got to bring it down. So just like double whammy, the jobs data was really poor for 2 months. And even the unemployment like creeped out a bit. Of course, the 10-year treasuries, interestingly, the 10-year treasuries actually went down to 1.4, then actually bounced back up to 1.5. I think some people are just reading it at, although there's no jobs because lack of supply, then actually there could be wage inflation now. But again, that is up to subject to debate. But this is how some bond market, how the bond market is interpreting. That's why the treasury or interest rate is down, then bounce back up. Obviously, we are very interested. I mean, we need to kind of get a sense of how the interest rate direction. Later, we'll just brief you on Singpost results. Anyway, for the near term, obviously, we are still cautious because of the pandemic and lockdowns in Singapore. Our preference tactically is actually some of the SGX listed European and US REITs. So the rationale for this is basically threefold. I think, as we all know, I think US and Europe, the number of cases continue to contract sharply, and then all the lockdowns are starting to remove. So this is good for the developed markets. As you can see, even Spain has removed their emergency. And also the second reason is with this jobs data and now interest rate expectations are lower, and also interest rate most likely is going to just trend sideways for the near term. So obviously these are positive for REITs. And the other thing is that in the inflation beneficiary, what we mean by that is that this is more targeted for the European REITs, because for the European REITs, the way to raise rental rates depends on inflation. If you look at something like iREIT, it depends on German inflation. So obviously the last few years there's no inflation, but right now, if inflation rises, actually it's beneficial for some of these European REITs. The bullet point at the bottom is just some of the events. So for this week, we will have 2 webinars, Penn United and APEC Realty. I know there was a question on YOMA, so YOMA will be coming, so give us some time. They will definitely be presenting, so we will update you on that. But the upcoming ones are these 3. So if anyone is interested, you can just sign up in our Powens web page, the link below. Next slide. Next slide. Okay, we just go through our usual update of COVID cases. You can see on the blue line, the global numbers. It is down slightly off the peak, the blue line, but you can see that month on month is still rising. I mean, so we're still growing at 30%. I think the rest we all know, there's all kinds of variants these days. Next, or mutations. Next. Then for this chart, we just want to have a quick update what's happening in Asia. So in Asia, the one in yellow is Malaysia. So you can see that Malaysia now, we don't have the updated ones, but because this is a weekly average. So right now, Malaysia is hitting 4,000, 5,000. Even the authorities are worried it could hit 6,000, even 7,000. So Malaysia is like almost getting a huge third wave or even tsunami, I guess. Then of course, we have India, and then even in Japan, the cases are climbing up, but again, they seem to be stalling a bit. The good one is Europe. You can see everything is trending down. France is down, the blue. UK is down, then Italy is down, and then they are removing quite a bit of restrictions in European countries. Next slide. For Singapore, I think we know what's going on. The cases is still up, but I guess for us, it's just to gauge. Right now, the average daily case is 5.6. Phase 2 last time was about 7. So we are still trending within the phase 2 levels. So, I mean, if this continues, I mean, just numbers-wise, then obviously the phase 2 could be extended from the current end of May if we continue to have this like 6 to 7 per day, which is like the average during phase 2 and 18 June. Next slide. Okay, this one is just to, I guess we all know how bad it is. I mean, this is just basically the left chart is the amount of tourists coming to Singapore. So just to give you some numbers, I mean, right now, the whole year, if you take the current month, the whole year is roughly like 6 days of pre-COVID. Basically, there's nobody coming in. I mean, just to sum it up in a nutshell. The one on the table on the right is just the RevPAR. So you can see the 110. So 110 was during the December holidays. So you can see even though we had like the rediscover voucher, holidays and all that, and most the RevPAR only goes to 110. It's still like 50% below the pre-pandemic, which is about 200. So whatever voucher you want to talk about, it doesn't really help. So it doesn't really move much for the hotel industry. It helps obviously from $60 now to 110, but still way below the 200 plus pre-pandemic. Next slide. Yeah, next slide. Yeah, okay, okay, this one just to show you the numbers. I think I won't run through. This one is just to show you the US employment, just for illustration. Next slide. Okay, I'll just go through this my second last slide. This is just on the Singpost. So Singpost is a bit complex, but so Singpost, the results was down about 56%. And then the underlying profit for the FY20 is actually down from 91 to 48, 50%. So I'll explain why later. The dividend also was cut from 2.7 cents to 1 cent. But the good thing is that for the year, they actually generated a lot of cash and they're in a net cash position. So the big problem for them is the biggest profit, one of the big ones come from post and parcel. So post and parcel means you get you get revenue from delivering our mail, delivering our parcel. But I guess the one that's less known for investors, I guess, is the international mail and parcel. Sorry, what it means is that they actually, maybe I highlighted before, they actually bring parcels from China, consolidate it in Singapore, and then they will ship it up to Europe and US. So they were doing reasonably well. Of course, they are very competitive. Otherwise, I'd rather just send it from China to Europe. I want to come to Singapore. So what has happened? But the problem right now is that because of the lockdown, there are fewer flights. So it used to be like 100 flights a day in Singapore. Right now, it dropped to 20. So as a result, the cost of shipping from Singapore to Europe, all that has obviously increased because there's less space, right? It used to be they put the parcels in passenger planes, but right now with fewer planes, the prices all got beat up. They call it the conveyance cost. So as a result of that, to be competitive, they just bid. So long as they are marginally profitable, they will continue to route. They will want to keep the route because they need the volumes and they want to be competitive. So as a result, the earnings for this division totally plunged. Domestic parcel, of course, is doing well because of e-commerce. Logistics did well also. Logistics for them, they also do like warehousing, especially in Australia, and then of course property rental. So for Singpost, there's basically two structural challenges. I think letter mail, we all know, is declining. I mean, hardly people send letters, obviously. And of course, it's the e-commerce transition. Because Singpost is not optimized for letters. I mean, the infrastructure right now is mainly for parcels. And just to give you an illustration, I think they mentioned even the mailman now can't carry enough parcels because it's meant to be carry letters. So you carry it on a motorbike, how much parcels can you actually carry? So even up to that extent, the infrastructure, they cannot cope with parcels. So they need to invest in the infrastructure. And just to give you a flavor of, so they used to be like 20 letters for every one parcel. So right now, every 10 letters, there's already one parcel. So they have to plan for the future. They have to plan for a scenario where one parcel, one letter. So they need to reinvest in the whole infrastructure. But of course, the opportunity is there. I think right now there's almost 300,000 parcels per day in Singapore. And people still prefer the postal way because it's cheaper and especially for small delivery, and 70% of the parcels actually can go through their letterbox. But the thing is that you need to optimize it. You cannot be like the postman walk to each unit and deliver. So some of the solutions they're talking about is just post parcel and so forth. I won't dwell too much now, we don't have coverage, but just to give you a flavor of what is happening and what was discussed during the analyst briefing. Okay, next slide. Okay, last one, this just for reference. These are all the, as you know, those announcing interim results have to announce by the 15th. So this basically everyone should be releasing the results. So this is just for your reference. Those in yellow will be what we cover. Okay, Yoma also releasing latest by 14. So anyway, this will be my last slide. I think we can move on to questions if there's any. Thank you everybody for listening in. Okay, there's a question on SPH. SPH has surprisingly spun off its core business, reducing itself to property management company. Does the SPH have competency? Sorry, let me on my video. Sorry. Cannot on it. Okay. Anyway, does the SPH have the competency to compete with experienced peers? I think I wouldn't say, but they are building. Their competency is mainly on PBSA, and they've been doing reasonably well, I think, for PBSA. I think the main one will be PBSA property development right now left in the portfolio. Some investments, of course, and also the Kupang, and also, what was the elderly home, and also what interests me most is their data centers. They got a huge data center, almost 1 billion development. So I think that will be the big one in terms of like one-off gain for them too. Competency was hard for me to say, but they've done well. I think for my own view, for PBSA, they really built up the size of it. So PBSA was hardly anything, and they managed to build up a portfolio of almost 1 billion, I think, gross assets. And they will look to list that too. So, it's you're putting me hard for me to go and comment on their management, but they've done well. I mean, to move away from media in that sense, because I think most of their assets actually, the PBSC actually enjoyed revaluation gain. I think that's the best we can say. But in terms of the new target price, I think Timothy, can you just reiterate what's the valuations? We don't have coverage, so can't give you the target price.
Yeah, so I'll just combine this with the other question about Kopang. Okay, so currently now the valuations, if you strip off the media business, is 9.4 times PE. So if you take the average PE for the past 3 years, the average is about 13. Okay, so then because currently the view of the valuations, why it's low and undemanding, is that it's still below the levels that SPH, the PE levels that was previously when SPH still had the loss-making media business. So if you remove the loss-making media business, then of course earnings will improve, and that's why we should see, logically seeing it in that perspective, the PE ratio should improve after you remove a loss-making business, but it still hasn't improved. So that's why the valuations still look undemanding. And then there was a question about Kopang. Do you have the info valuation of their investment in e-commerce company in Korea? Thank you. So the valuation now, SPH owns a 0.1% of Kopang. So currently that equates to about 66 US million, or about 85 million Sing dollars. So if you, that's another avenue of a one-off gain, and SPH can only sell that stake in Kopang in September this year. So if you take the 88 million and you consider it as a profit, it's about 30%, about 34% of FY21 estimate earnings. So you can, if they actually decide to sell it, you can actually see a uplift of up to 30% in their profits this year. Yeah, so that's the valuation. And
the Kupang, I think, right, Timothy, the Kupang, they value it at about 60 million. So they value it at IPO. So it's already taken into the book value, but the most recent book value, right? If I'm not mistaken. So Kupang, I think we did back the envelope because they value it at IPO because the year end was before the listing. Then even if you mark it up, maybe another 30 million upside to Kupang. I mean, the last time we checked. So it's not going to be very, very meaningful for them. But of course, it's still a nice chunk of cash for them to maintain dividend and so forth. But it's not like a big move on the book value, if I'm not mistaken, right? Timothy, you said like only.
Yeah, the movement on the book value is nothing much, but on the profit, we sell it, it can be about 30%. Yeah.
Can you move on, Natalie? Sorry, Timothy, you got some more? Sorry. Yeah, go ahead.
Yeah, let me just take the one more SPH question. Your thoughts on SPH and other potential GLC restructuring options? Other potential government-linked company restructuring options. It's not hard to say. Yeah, this one no comment because we won't be able to speculate on what other government-linked companies will be restructuring in the future.
Yeah, I think the restructuring has been like getting rid of all the unwanted parts of the business. The one we always thought was SIA Engineering. I think we always thought that I mean, this was pre-COVID. We thought that the SIA Engineering, because ST also it makes sense for SIA Engineering to merge with ST Engineering's aerospace division. So that's what we thought again, but all this is speculation. It's hard to play on it. But that was the other one that we thought there would be something happening behind the scenes. Apart from the other obvious ones are like Keppel and all that. Yeah. Okay, I think we can move on. Natalie can take the rest. Yeah.
Hey, sorry, I couldn't unmute. Okay, so I one question regarding Ascenders. Will Ascenders be conducting any new acquisitions for the rest of 2021? So I think just last week, Wednesday, they announced the acquisition of the remaining 75% stake in Galaxis, which is their business park asset located at One North. So they already hold the 25% stake, which they bought from Mitsui Company Limited. And now they're acquiring the remaining 75% stake from their sponsor, Capital Land. Yep. Okay, so in terms of acquisition size, this acquisition comes in at about $500,000. And in comparison to how they have been acquiring in 2018, 19, 20, which has been around the $1 billion to $2 billion number, I think that probably there might be still some room for Ascenders to acquire if they can find some of the assets. So, they didn't have a briefing this quarter. However, in the most recent briefing that we attended, which was for FY20, they mentioned that they have passed on some deals and they are actually targeting a 30 to 40% percentage of assets, overseas assets. However, this of course is not a hard target, meaning to say that probably they will continue to acquire from overseas. I think they have actually reduced the amount of Singapore assets to close to like 70, 75-ish. Of course, they still have a $1 billion pipeline of assets from their sponsor. Yeah, and they still see some opportunities to acquire in Singapore. Yeah, so I think overall we should be able to expect some acquisitions from them. And as we know, they prefer to be a large mover, meaning that they like large acquisitions, and to have a meaningful stake. Of course, if they were to continue to expand their exposure within the countries which they already have presence in, which are namely Australia, UK, and US, then probably they might not need to make such a very, very big acquisition because they already have boots on the ground. Yeah. Another question would be, in the recent weakness in REITs such as Capital Land, CRCT, CICT, MNEC, Mapletree North Asia Commercial Trust, and Ascenders REIT, due to the questions are jumping, due to the COVID surge in the region. From what we can tell, for CRCT, actually the price has not really shifted that much. For CICT, yes, and for some of the retail REITs, for example, the likes of Fraser actually took a substantial dip after this rolling back into phase 2 has sort of been announced. Overall, I think, like for example, Ascendas, I think the movement in share price was due to the recent placement which they have conducted due to the raising of funds for to part finance the acquisition of Galaxis. Yeah. So I think overall, the impact to share price due to lockdowns will be more prominent for those REITs which have already sort of recovered close to pre-COVID levels. Whereas those that are still struggling, they might not see such a larger impact to their share price. Yeah. Okay, that's all for me for this question. Okay. Let me just see if there's any more at the top of queue. There's a Q&M question that's up next.
Yeah, we will take all the fundamentals before we go to the TA. The question is, QMN Dental had multiple initiations in the past months and is a beneficiary of increased testing. Share price has not moved much. What is the pushback from investors? I think investors are just not clear on the testing. They haven't really seen the revenue, so I think until investors kind of see the significance of it, I think most are still unclear how much can they do, because they don't really tell, they can't disclose, because all this is government. All these are government projects. So I think investors know they have testing, but they're just not sure how much, how large can it be. So I think the results will be will hopefully show some of these numbers, and also anyway, they should be releasing the results by the 12th. So hopefully, you can see some of that data coming in. But no doubt, I think with the current situation, there'll be more and more testing happening. Once the results over, we'll definitely do a webinar with them. Then, if you have any other further questions, you can ask them. Thanks. Thank you for the question. Cherry.
Okay, hi, I think there's a Yoma question, so I'll just read it out. Any update on your previous stock pick, Yoma? And you also mentioned that you'll be arranging for a webinar. So when is it expected to be held? Okay, so for the counter, today there hasn't been much change. The coup is still ongoing. Businesses are still disrupted, and also this is likely to persist in the near term. We're looking at a timeline of a year, as in till the end of the 1 year state of emergency that was declared. So all in all, we are still neutral on the counter because we are not seeing a turnaround as of date. They'll be releasing their 1/2 results this coming Friday or next Monday, so we should have more color by then. Regarding the webinar, as Paul mentioned, we are actually in talks with them. Previously they had their blackout period, so they weren't able to do it then. But post results, we should be able to arrange one with them, so you can stay tuned for that.
There's one question on Keppel, and I'll probably address some of the bank questions as well. So let me read the question on Keppel. Keppel Corp seems to be dropping. Why? There are no new news on Keppel at this moment. So we see this slight correction in Keppel as being mostly in line with the broader market drop. But based on their first quarter 21 results, the results were largely positive. So no change to our call as well. Yep, that's all. If I didn't answer your question, just let me know. I'll go on to the banks. So I have one question here. So of the 3 local banks, which one has highest potential growth? Please rank. So for us, our top pick amongst the 3 local banks will be OCBC because of the stronger than expected results. We also see the reversal of allowances for OCBC as being more positive versus the other 2 banks. As a whole, the 3 banks did well for first quarter 2021, but we see great upside potential for OCBC. After OCBC would be DBS. Again, DBS we see the potential for a dividend hike as being equal to OCBC as well. So DBS would be the second. Then third would be UOB. We're just slightly disappointed by the higher than expected allowances for UOB. So UOB would be the lowest rank amongst the three. Yeah. There's one more question. Hi Terence, FA, please advise the OCBC's valuation. How do you arrive the value for beta, equity, risk premium, and the risk-free rate? Yeah, so for the benefit, yeah, thanks. Maybe you just go to that table so that you all can see. Yeah, this is this table. So we'll go beta first. Our beta is 1.1. It's 1.1 now because it's a OCBC lecture index stock, a very heavy constituent of the Singapore, the Straits Times index as well. So usually it trades in line. So 1.1 times is mostly in line. But if you want to know how we get this number, we derive this number through Bloomberg lah. Then equity risk premium. The equity risk premium is we arrive at the equity risk premium by assuming a market return for the STI. So we take about 7% market return for the STI. So the market return is just the 10-year historical market return for the STI, and then we minus the risk-free rate. This is actually a finance formula lah. Yep. And then so the last question is the risk-free rate. The risk-free rate is what we do is we take the 10-year average historical. No, sorry, the 10-year Singapore Treasury yield, and then the average yield for the 10-year Singapore bond yield. So why average? Because the 10-year yield can fluctuate. So we just take an average so that is more indicative. So these three variables would give us the cost of equity. The cost of equity formula is we use the capital asset pricing model, which is the risk-free rate plus beta times equity risk premium, which will give you, if you take that, you get a cost of equity, which is a component of your target price to book value. Then it gives you the valuation for OCBC. So actually very all formula based. Yeah. Let me know if I may answer your question. If I didn't, just drop a reply. Okay, let me just see if there's any more questions on the banks. Yeah, I think that's all. Yeah, thanks, Clifford. Thank you.
Hi, Ned. Do you want to answer your ESR question first?
Okay. Hi. Yes. Thanks, Viren. Okay. The question on ESR is, how is the outlook for ESR? Would there be a public placement in addition to the recent private placement? So the private placement, for ESR, they are intending to raise 150 million from equity. So 100 million will come from the private placement, which has recently closed. I think it was done at about 3.4 times. It was 3.4 times covered, and an additional 50 million will be done with via a public placement to the existing shareholders. Yeah, preferential offering. Yeah, and in terms of the outlook, recently, just last week, they actually announced 2 acquisitions. So one of it was actually a 10% stake in an Australian logistic portfolio. So this Australian logistic portfolio are roughly about 37 assets, 2 of which are still under development, as well as 2 land parcels. So it's a logistic portfolio. Sorry. So they actually buy a 10% stake, and this will be their first acquisition overseas. Yeah, or rather their first investment overseas via this fund which they are investing in. The fund is actually 80% owned by GIC, which, as we know, is Temasek linked. And the sponsor, ESR Cayman, actually owns 20% in this logistics portfolio. Yeah. So they're only buying 10%, which means that they still have a potential to buy over the sponsor's remaining 10%. In addition to that, they are also acquiring another asset, which is 46A Tanjung Peru. Yeah. And that asset is a logistic facility. And of course, I think these two acquisitions have the potential of being a catalyst for ESR. So I think that's positive in general. Yeah. Okay. I also saw another question for CapitaLand. Okay, let me scroll to the question. Give me a second. So I think the question was about, the question is about the target price, as well as the outlook, if I'm not wrong. Okay. What do you think about CapitaLand's restructuring and target share price? So our target share price is $4.38. And we like the acquisition, the restructuring, namely because, of course, it allows the current existing shareholders to exit the development business at a 0.95 times price to book. And of course, historically, CapitaLand as a whole, they have always been trading around 80 to 70% price to book. So this, of course, is already an immediate unlocking without actually having to hold on and slowly realize the ROE, return on equity. And another positive, of course, is that while the assets that will be the new entity that will be listed, CLIM, CapitaLand Integrated, CapitaLand Investment Management, or CLIM for short, that vehicle will actually be holding on to the stake in all the REITs as well as the management capabilities of the REITs. So it's a full stack investment management company on its own, and in general they actually tend to trade at a premium to earnings. Premium to price to earnings. Yeah, and so that actually, when the consideration which is paid out for 1 unit of CLIM shares is actually done at 1 times price to book. So that means that there is actually a potential re-rating for this new entity that will be listed. Yeah. So overall, we see it as positive. Okay. Okay, I'll pass it down to Weiren for now.
Okay, thank you, Natalie. So yeah, so I'll do some questions. So I'll do some of this. So perhaps I start with IFAS. Due to time constraint, I won't do ESR and HRNet. I will do ESR. Okay, so for IFAS, right? First of all, IFAS, I think, despite its stellar upside, since it broke out of the sorry, I forgot to share screen. Yeah. Okay. So yeah. So if you can see my screen, just raise up a hand so I can know that okay, you're actually looking at the same screen. All right. So good. Thank you very much. So first of all, I'll do on sets sorry, IFAS. So if you can see that IFAS actually has a stellar growth, steady upside, but it's still kept within the $6.68 psychological resistance level. This is what the 61.8 and this is what the 61.8 Fibonacci level is actually. So I remove it. So this is the level I've been watching. So you can see that there's a sharp down for this for the past week since it breaks above $6.68. So hence I'm still looking at the target of $4.99 to $5.30 before rebound back to the upside again. Okay, so next one I'll move on to HRNet. So HRNet, okay, so HRNet, still the uptrend is still ongoing as price is still trending higher above the 50-day moving average. Just that I believe the momentum is slowing down. Okay, so any upside we won't be seeing any strong upside at the moment for now. All right, so that's for HRNet. And the next one will be SET. So SETs, right, broke off the support zone at 407 to 416. Hence, I think price is going to retest 407 before a sell down once again. So it fails to reach the higher resistance level at $4.91 to $5. So yep, I'm staying put for now for the sets. All right. So the next one will be 酒店. So 酒店, right? I released a report, I think last month. I think the start of April or mid-April. I can't remember. But price is still on a larger consolidative pattern or symmetrical triangle. So hence, it breaks off the smaller ascending triangle, which I mentioned before. Price is still in consolidative phase. So hence, any upside, I'm still like positive about the upside for 酒店 chemical. Perhaps it will just retest back at the lower support at 0.093 before a strong rebound thereafter. All right. Okay. So next one will be Jaffa. Jaffa large bullish flag is still intact, but due to the price has already broken below the 50-day moving average. So hence, I believe that 0.81, 0.835 will be the better support region to bring the stock forward on the upside. So do look out for 0.810 to 0.835 for Jaffa. All right, Singpost fails to close above the 50-day moving average despite the golden cross over here. Hence, I believe that the support between 1.31 to 1.42 will offer a good support. But highly likely, this support zone between 1.31 to 1.42 might be broken, given the fact that it struggles to close above the few hour gap. And this is actually a breakaway gap that we're seeing. It means it signifies a start of a new downtrend, unless it's filled within the next 4 periods. Otherwise, we see continuous downside again. All right, that's for SPH. So SPH REIT, the downtrend is still ongoing. All right, this is much more a corrective phase, but however, the multiple testing at a resistance zone between 0.895 to 0.920 offers a much more like a weakened resistance zone. Hence, I would believe that the upside maximum will go is to near $1 region before it comes to a crashing sell down. All right. Okay. So next one will be DBS. DBS fails to close above $30 this morning. So this morning, the highest price that it reached is $30 before a sell down coming. So we need to look for the end of the candle tonight. If it closes at a bearish engulfing, then we'll expect prices to fall back to $28 before a rebound back to $31.50. Glove stocks, the inverted head and shoulder is formed, but the deep pullback seems dangerous. So the next price we're looking at is 1.57 support region. And if this level do hold, then we can see a further upside to 1.81, which is my target price. 1.96, which is my initial target based on my report. But however, I cautious everyone that top glove need to clear $2 strongly before it can establish a renewed uptrend. Otherwise, I still see that this might be a corrective upside in response to a bearish downside. All right. Okay. So next one will be ComfortDelGro. So ComfortDelGro failed to hit my target price once, and it came crashing down. So this one is like more of like a inverted, more like head and shoulder, and then a double top fails to close above 1.81. Hence, and then it has a deep replacement below the 50-day moving average and the resistance and support zone. So hence, for ComfortDelGro, I'm seeing more downside. So for now, I will stay away from ComfortDelGro for now. All right. And then last but not least, it will be the SIA. SIA has a renewed 3-wave pattern for downside move. So likely if this bearish candle is going to close strongly tonight, 4.79 support level will be a threat to be broken. So to take note of that. All right. And then will be AEM. Okay, so AEM, I think likely the pennant pattern is not forming. So is really breaking it breaks below. So we most likely going to form other patterns. So we shall await. So I think AEM has already closed below the strong support, which I mentioned previously, $3.63 to $3.72. So hence, and it has really closed below the 200-day and 50-day moving average. You can look at the Ichimoku. You can see that this is a very is a renewed downtrend rate. So hence, I think AEM I'll stay away from it for now. In fact, the selling may sell until $3 before a rebound. All right. Okay. So next one will be the Hong Kong market. Someone asked. Okay. So will be JD Health. JD Health inverted head and shoulder was fulfilled already. So hence it didn't really reach target 2, which I expected to be, but we have to see how's the support level at 1.08. Is it being well supported? Seems that it's well supported at 110 to 108.5. But however, I think price today managed to cross above 50-day moving average, but not the neckline resistance and support level at 118.9. So hence, for that, I think in order to confirm the upside to 140 region, then we need to see a strong upside back above the 118.9 psychological support turn resistance turn support neckline level. Okay. Then I think Baidu strong downtrend, obviously. So needless to say, any upside you need to break $200 Hong Kong dollars and $200.60. Otherwise, I won't even take a look at that. All right. So let me see, is there any other technical? So nanofilm. So nanofilm check. Okay, so nanofilm best price I think is the support zone 2, 4.459 to $4.70 will be a good price to enter for rebuy to a buyback. All right, thank you, Mr. Chan. Okay, so let me see the Jardine CNC. Okay, so I'll do a Jardine. So Jardine issue a buy call. It rebounded at 22.82, which is my buy limit level, but price did not sustain very well, did not respond to it very well. So hence, I think let's see if we hit my stop loss below $21.80 or not. So but obviously looking at a larger trend, the ascending triangle, the multiple resistance being tested, I believe that there will be a strong upside. Otherwise, you can look at the deeper retracement at this level at 19.69 to $20 for rebound. All right. Okay, so venture UMS. Okay, so I'll do the last two, venture and UMS, and before I hand my time to my colleague to answer the rest of the question. So venture, I did issue a buy call. So however, it did not fulfill. It did not successfully break above $20.68. The highly coveted multiple tested resistance zone. Instead, it continued to fail, and it continue. If you go down the lower time frame, it confirmed the pattern that is falling. So hence, I'm bearish. I'm turning bearish on that. So where's the good price? I think I'm reverting back to $17.22 to $17.44 for a bullish rebound. All right. Last, I will be looking at UMS. Okay, so UMS hit my target price 1. Target price 2, I think I still need to wait at 1.28 to 1.30 for rebound. All right. So it do have a similar pattern like Franken. So yeah, we shall see how this level is going to hold. All right. So with that, I pass on my time to my other colleagues to answer further question. Thank you.
Yeah, Okay, I think we'll just try to take on a few more, then we should try to end it by 12:45. Is it okay for you, Viren? 12:45.
I will take my leave now to set up because I'm in office today. So I'll take I'll take my off now, and 12:45 could you end it for me? Thank you.
Okay. Okay, thanks everyone. We try to take a few more questions. Thanks everyone for all your questions. The first one, why Asia Pay TV shares have been dropping year on year? Actually, there's no particular. I think everyone is just, if you the latest in the latest AGM, they did there was a Q&A, so they did publish some information on the 5G. There were a lot of questions on 5G and data backhaul, and I think they repeatedly mentioned that data haul will be a key component of the revenue. I think this as most as can be disclosed, and I think people are just waiting for that as the new revenue driver. I think why has been dropping. I think just that in the near term it's just the high dividends. There isn't really much growth, so maybe investors are just hoping for some growth before they come in. Again, I'm just guessing. I mean, our target price is still 15 cents, and we think that the 5G will come in, and also the yield is attractive, and the yield is paid quarterly. I think 8 or 9% dividend yield is paid quarterly, and it's well supported by the cash flows. So we still like it. Yeah. But I guess investors have just been disappointed many times before, obviously, and so maybe they just want to see that 5G coming in, and not just talk about 5G, have the revenue really coming in. Again, this is just my own thoughts. Okay. We move on to the next question. Any chance SingPost will follow SPH shocking trick? Okay, I'm not sure what shocking trick, but I guess you mean selling the more problematic parts of the business. For SingPost, will be a bit more difficult because all the businesses are interlinked. Because the one that is most problematic right now is letters, and you can't remove letters, and because you also have to have parcels. So I think it's going to be a bit tougher for SingPost because the businesses are all linked. Like you can't have the mailman deliver letters and another one deliver parcels. So I think it's going to be quite challenging for that. And the other one that's weak is the international parcels, not those from China. I don't think it's going to be hard to strip out because it's all interlinked. Not like SPH got media separately, and then student dorms, obviously they are nothing related to each other. Yeah, I hope that helps answer. Any reason why Singapore government not shutting the border down for Malaysia? It's politics, but I guess we need the supplies from Malaysia. If it really shut down, I mean, touch wood, I think Sing Song will get affected because there's not going to get any food from any essentials from Malaysia. Again, this I guess it's not an investment question. Move on to the next. Today headline: Singapore put brakes on data centers. Does this impact Capital DC REIT? Natalie?
Okay, thank you for the question. This is actually quite interesting question. So yes, it was really just announced about 6 hours ago about this pause on data centers. So if this really affects Capital DC the most, I would say. So as we know, Capital DC actually derives a large portion of their income from their Singapore data centers, which are all co-location assets. And over the past few years, they actually have been acquiring overseas as well to sort of go around this difficulty of acquiring data centers in Singapore. However, this moratorium on data center supply has benefited the Singapore data center industry as a whole. I think the article pointed out that the rents for data centers, which are actually charged as a sort of based on the kilowatts used, has actually increased by 30% just last year. The article also pointed out that apart from Singapore, some countries which are also known to be like the main cities in which data centers are very prevalent, like Amsterdam, they have also sort of initiated their own moratorium in 2019. So this doesn't mean that Capital DC will not be able to sort of unlock further value from their Singapore data centers. Of course, over the next 2 to 3 years, we do expect a creeping up of the rents. That is one. Additionally, as we know, Capital DC also has another asset, which is DC1, leased to MediaCorp, and currently 2 out of 7 floors are shell and core. 2 out of 7 floors have been converted to fully fitted data centers, which allowed KDC to actually charge additional management and fees for this fully fitted versus shell and core kind of outfit. That means to say that there's still potential to convert the rest of the 5 floors into fully fitted kind of lease structures where they can still charge higher rents, for the management. So apart from that, sometime earlier this year, I think it was announced that Microsoft was going to go into Malaysia, and it was quite a large move into Malaysia. So of course, this also allows Capital DC. Capital DC can also continue to grow their presence in Malaysia. Currently, they only have one asset, which is the Basis Bay asset in Malaysia, which is actually not doing so well. I think their occupancy is about 63%. Yeah, and so that's it. As Singapore closes up or clamps down on data centers, there's still other opportunities, other locations where opportunities may arise for data centers. Yeah. I think additionally, one last point to note is, okay, never mind. Let's not go there. But yeah, so all in, I think that there are still, as I mentioned, one door closes, one door opens. So that there are still opportunities to look in the neighboring countries like Malaysia for opportunities. Yeah. Okay, so that's it for my question.
Okay, one question about restructuring to SPH REIT. Will it affect restructuring to SPH? Will it affect SPH REIT? No. So nothing much. So they'll just SPH will just give a few million shares to the media company so that they can tide over their expenses using the dividend from the SPH REIT. Then there's another question for SPH. Why do you use PE to value SPH post spin-off of the media business? Will it will become a property company? Shouldn't it be valued using PB? Meaning it should be at 30 to 50% discount to NAV. Yeah, we use PE for this valuation is because we wanted to see the impact, the impact of the loss-making media business. If we strip off the losses from the media business. So we try to value it based on PE because there's uplift in earnings. Okay, and there's one more question on the SPH restructuring. Is it not delisting? Yeah, it's not delisting. It's just removing the media business from the SPH. Yeah, that's all for me.
There's one. I think there's one follow-up question on my point earlier about the banks. I'll probably read out the question. Sorry, I think let me just scroll to the question. Yeah, what about terminal growth rate? So our terminal growth rate is 2% for OCBC. So the terminal growth rate is derived, like the name suggests, is the really what want to try to get is the long-term normalized growth rate of the country, the country in which it operates in. So we put 2% to signal the long-term growth rate of Singapore. Yep, that's all.
Okay, let me just try to take on some. Then after we end it up with Vivian. Vivian, you want to do first your Fortress?
Okay, sure. Just a moment. Okay, yeah. So the question on Fortress Minerals, let me read it out first. Oh, so is Fortress Minerals still a buy now? So yeah, the share price has gone up a lot. I think it's now hitting 70 plus cents when and my target price, I think the report released almost a month ago, is around 64 cents. So anyway, it's a commodity stock, so it's mostly driven by the increase in the iron ore prices. So back then when Fortress Minerals released their results, we were talking about iron ore prices at 180, and it was reaching a 10-year high. And over the last week, I think mainly due to the China-Australia tensions, the iron ore prices have hit $200, which is a first time in 14 years. So that's the effect on, I think, the relation between the largest iron ore importer and the largest iron ore producer on iron ore prices. So going forward, I think it is unlikely that, you know, even with these tensions in their relations. So there was this, basically touching on the update on the relations, is this suspension of China-Australia strategic economic dialogue. So they were supposed to have a dialogue, but it was, I think, suspended. And it won't affect the amount that China imports from Australia too much, I think, because of the fact that mainly China imports 60% of the iron ore from Australia. So it is very tough for them to, you know, shift this amount substantially to other countries. So they have been shifting some iron ore factories or producers, the Chinese ones, to Malaysia. So including Alliance Steel and Eastern Steel. And with that, oh, sorry for the mistake. They have been shifting the steel producers from China to Malaysia. So with that, they are trying to diversify their steel producers. And from the iron ore imports kind of point of view, they are also trying to rely more on countries like Malaysia, but it is still very small compared to the amount that they import from Australia. So going forward, we don't think the iron ore prices will cool down that fast. And it is likely that because the stock price is closely tied to the commodities price, iron ore prices, then it won't normalize in the near future. So our target price is still under review. Yeah, that's all for Fortress Minerals. Hope that helps. Thank you.
Okay, I'll just try to answer the last few. Why are glove stocks and stay-home beneficiaries such as Sheng Siong price dropping despite phase 2 and the worst COVID situation? Anyway, for the glove manufacturers, what happened was that is it Kosan or Supermax? I think Supermax released their results. They're one of the top 4 glove makers, and they've mentioned that glove prices have started to drop, and also the spot price now is lower than the contractual price. So as a reason, that kind of had a hit on all the glove makers, and that the prices are all down now. I think, yeah, it should be Supermax, not Kosan, sorry. So that is one of the reasons for the weakness across all the rubber gloves. For Sheng Siong, it's a different situation right now. I think Sheng Siong, you're not sure how long this lockdown, and it's not as severe as during the circuit breaker. So I think that is why and as you can see, in March the sales was down 14%. So for 2021, Sheng Siong is going to compare with a ultra inflated year 2020. So the numbers will still reflect a decline, which we already kind of factored in. And this is nowhere near what we had in last year when people were pantry loading or basically hoarding of supermarket goods. So you don't see that effect as what happened in 2020, and you're not sure how long this lockdown, this so-called phase 2 will last. So I think these are some of the reasons why the price trajectory isn't the same as in the previous. I try to answer this last one. So sorry if we missed some, but what is Singpost outlook with e-commerce competition remaining strongly? Why it performed badly after Alibaba purchase? Alibaba purchased the stake, I think 2016 or 2017, I can't recall, somewhere around there, at 170 something. The story was to be like a provider, to be a logistics provider for Singpost. But I think the problem was why Singpost did well, of course, during 2015, 2016, when the share price hit to almost $2. One of the reasons was because I think people forget, they thought there was a lot of growth in SingPost, but actually it was because in 2014 or 15, our domestic stamp rates actually rose. And that was one of the main reasons why the profit went up. It wasn't because of e-commerce. Of course, at the time, number two, they made a lot of e-commerce acquisitions, and then a few years later, I think last year they had to write, or the year up before, they had to write down almost 250 million of investments. I think the previous CEO had invested a lot in all kinds of e-commerce. So the story for SingPost was e-commerce, but I think the reality is that it is the infrastructure, like we mentioned, is not set up for parcel. Competition is different. I think competition, you're talking about Ninja Van and so forth, that's not where SingPost is competing. SingPost is for those parcels which can fit the letterboxes. Like, I don't know, according to them, like 70%, those small items. They're not going to do the $2 and go to your house and deliver. That one's like, they have another arm for it in Malaysia. That one doesn't make money. So that is not the competition. Again, I'm sorry, I'm all over the place. I don't really cover the stock, but that is some of the answers. I hope that answers it. Why UG price? I think there was this Supermax. So the worry now is how steep is the fall in glove prices. So that's why it affected the rest. Okay, Thomson we don't cover, but Thomson, I guess if you look at the recent results, where there was a lot of noise of Thomson returning to profitability, but a lot of the profit actually came from other income or government grants. Yeah, and also, they're going to build a new hospital in Malaysia, and that's going to be very, you build any new hospital, you just lose money for a few years. So we don't cover it all. They don't even see anybody. So, but this is just the glance of their results. I think we have to end it. So sorry. I know some of you have some questions left. Again, just go to our website, Stocks BNB. Under the community page, you can post a question. We will try to answer. We'll try and type out and send you the answer there. In the meantime, thank you everybody for attending. Because Weiren has a 1 p.m. US technical, so we don't want to intrude on him. So thanks everybody. Stay safe, and thank you again for taking the time to attend and for all your questions. They're all very good questions. Thanks very much, and we'll hope to see you again next week. Thank you everybody. Take care.